Welcome to Quiver Financial's market update for March 2024. Find out what we're seeing in stocks, interest rates, metals, and oil. I'm Colby McFadden with Quiver Financial, joined with Patrick Moorhead and Justin Singletary. Gentlemen, welcome to March of 2024. Did you come over into the stock market? This is what we talked about in January. We said right now, and it hasn't changed, right now, the market is of one of two paths. Now, the first one was what we were a believer in all of last year, that eventually the rally was going to fail. That hasn't happened, and the window of time for that to happen is really like almost closed. Like for this pattern to happen still has to transpire in the next 2 weeks. Otherwise, that window closes, and we're definitely more so, I can't say definitely, but then the odds really shift that we're in this bullish pattern, and it may not make fundamental sense to a lot of people because it means a lot of stocks will get at much higher valuations. And so this path here on the right side fundamentally may make no sense to anybody. It could be one of those times that happens. And this is what people are expecting right now. It seems like the whole market has shifted into this belief system. So there again, okay, fine, we can allocate for this because the interest rate environment is also allowing us to do so. And then what we have to do is just watch for signs that if something changes in the next 2 or 3 weeks where this pattern on the left does develop, then it's pretty easy to move around it. But for right now, the stock market looks pretty stable. I wouldn't be shocked to see a 5-6% correction off of where we're at because we need to come back. We're at like 5,200 right now, 5,100. So the market needs to kind of come back to 4,800, do a little correction. And that's what I'm going to be watching for is in the next correction, if the stock market comes into this 4,800 level, 4,700 level, gets its footing and starts to pivot higher, then that's a really another confirmation that this right side is happening. So this is all very early stage. Like if we are going into another bull market, then right now we're in the first inning. The next correction is the second inning. And the most important thing will be, what do you do then? Because if we do have this pattern on the right side, the next market correction is where you get a chance to position for it. In the meantime, there's still a lot of things that you can do. Now, last year, one thing we were sharing with people, and I want to bring in a note of caution to the bulls and to that bullish picture, to that right side, is all last year, one of the reasons I was very concerned about the stock market is that, in my experience, is that when you have the stock market rally and then the high yield bond market and the small caps and the financials and real estate, when you have all of those things not perform in that rally up, it's a really bad sign. Usually that means that these rallies fail because these parts of the market weren't participating. So that has not really changed all that much because here we are. I think that this was what I shared in December, and then here's an update. Here we are now. All right, so on the left is the S&P 500. So you can see it's making new all-time highs. Below it is the high-yield bond index. It can't get off the mat. Above, on the top right, small-cap stocks, still greatly underperforming the large caps. And then you have financials on the bottom right, which now finally got peppy. Like they finally took off and caught up with the S&P 500. So if we are in a really, truly new bull market, then what should happen is the small caps and the high yields, they should break above these red lines and run really fast to catch up with what the S&P has done. So basically, this may be a precursor of what's happening here. So that's what I'm going to watch, is over the next couple weeks, if these markets can get above these red lines and stay above them, then that's another confirmation that, market is pretty damn strong. However, if these guys fail in the next 2 weeks and roll over, then that pattern of the bears is potentially there. So for me, in order for me to get really bullish the stock market, I sure would like the higher risk parts of the market to start to participate in the rally. And they've started to show signs of it, but not completely there yet. And then right in here, I just threw a little extra, traded real estate chart, because even though it hasn't performed like the S&P, it does look like it's broken its downtrend. So that's something I'm going to watch there. And if interest rates stay calm or stay in that Goldilocks pattern, then this definitely has broken out and becomes a potential opportunity in the future. So those are the things that I'm watching, and they tell me that you can buy high yielding stocks. Like you can go out there and you can buy dividend paying stocks, which we started doing in February. We've put in a lot of dividend paying stocks, a lot of them around the undervalued areas of miners and energy. And the market is very narrow leadership. What's pushing the S&P 500 higher is still just a couple stocks. Microsoft, it's not even Apple and Tesla anymore. It's just Microsoft, Nvidia, and I mean, if you guys remember one other that might be of the Magnificent Seven, I think only 2 or 3 of them are pushing to new highs, and the others have rolled over. So this market is very narrow, and you could have a correction at any moment. That correction, where that correction ends and what happens next tells us whether we're in a bull market or not.
Yeah, I saw today that I think it was Bank of America just changed their forward forecasting on the price of Tesla from I can't remember if it was 200 to 125, but they basically downgraded it by a substantial amount.
Well, the EV car thing has, the shine, the luster has come off that. A lot of the car companies are now backing off. All the big boys have realized, the demand from the consumer isn't there yet. So Tesla is feeling that, and now they have competition in China. I mean, the market's changed, but. I still like, when I look at charts and I look at things like Chevron and Exxon and British Petroleum and gold miners that are paying 4% and 5% and 3%, and they've been at the bottom of their trading range for a year. Those are the things that I think are undervalued in this market, and they play a catch up. And I don't mind buying stuff that pays a dividend, because even if it goes sideways, at least I'm getting paid to wait. So when I have a really narrow stock market where I know the risks, where the ice is really thin, then okay, I'll buy dividend payers. But the nice thing is the difference this year from 2022 and even the beginning of 2023 is that at least now we can go buy those dividend payers. Back then, when interest rates were rising, it was at such a fast pace, it was still too treacherous to do that. So at least now the environment allows us to go strive for some income.
You had, again, 2 options on the way the stock market could go. And I'm sure you remember in the 2000s, the mania, the craziness that was going on, the exuberance of, it was unbelievable that the market could keep going higher. And now in this year, 2023, 2024, we have Cacao going through the roof, Costco going through the roof, Elf, like you said at the beginning, which is a beauty company, going through the roof, Abercrombie and Finch, which, is going through the roof. So we have these stocks that are just going mania. Is it not, a lot of people reference this to a lot of things going on in 2000, time frame that we're having now. What are the thoughts in that regard?
Well, it tells me that the Fed, that's another reason I don't think the Fed is all that accommodative in the future, right? Because those things happening tell you that there's still a lot of liquidity out there. if you can get, like in this last earnings, there were big companies that, like, released earnings and their stock was up 20% the next day. So when you have that kind of stuff going on and you still have people buying $1 million, $2 million homes fairly easily, like when you have a tight inventory, it tells me that there's still a lot of liquidity out there. And that tells me the Fed's not going to be able to be that accommodative because they haven't accomplished the goal. It was August of 2022 that Jerome Powell said, "Oh, investors should expect to feel pain." That was August of 2022. And there was some pain in 2022, but it was like October of 22, 2 or 3 months after he said that the pain stopped. So I don't think the Fed has accomplished their goal of slowing it down enough. And those stocks doing those crazy things is an example of the liquidity that's still out there and why the Fed hasn't accomplished their goal yet. When you see that stuff not happening, then the Fed will be ready to lower rates. Is my opinion on it. But I don't even really worry about that stuff because there again, like if I own Chevron, Exxon, British Petroleum, those types of things, they've been around for 100 years and doing the same business. So right now, you just kind of take the Warren Buffett approach.